Morning everyone, Paul here with GamEdge. Today is Friday, the 29th of September, JPM Roll Day. Let's get started. Unlock your potential with a comprehensive suite of investing tools and expert education with GamEdge. Start your free 14-day trial today. Today is the JPM Roll Day. It is what we consider the Papa Bear. It's the big one. 39,000 contracts are set to expire today, and that'll enable JPM to put a new hedge on that will go out till December. Can be a little bit of a fireworks effort. We'll have to wait and see. But before we get there, I want to cover a couple things here. So yesterday, the zero DTE market model had what we call a new trigger day up, and we'll cover the slide here shortly. Note, because we're in a broader downtrend, and Tom, you'll love this, it is prone to failure. Just due to the overall broad market condition, right? So although we have what we call a tag combo 8, and those in the Discord who are following the market model know what that means, the broader context is that we are down. Another indicator we have, we nicknamed the railroad track. It's appropriate for the 1 to 3 day swing folks. Long entry signals are off. The short entry signals are off. Our recommendation is to sit on your hands and wait. If you go against the tick, you can, for a longer term swing, you can get eaten up, and we would advise you not to do that. The longer term model, which we call the ribbon model, it is appropriate for 2 weeks and beyond or so. It's been in a downtrend since confirmed on September 5th. And long entry signals are off. We are in a continuation short market, and as I said, that's a TC1 down. So overall, looks like we could potentially rally within an overall down market condition. If you're a bull, today is a trigger day up, so everything begins with a zero DTE, and I would play accordingly. If you're a bear, I would sit on your hands, and I'd wait for the potential of a failed bounce and then a re-entry to the short side. Three things I want to draw your attention to: the SPX PM Complex, which is front and center today because this is where the JPM end of month, end of quarter roll contracts are sit. We are seeing a drop in the transition. It's been very fat, very wide. We closed right at the bottom, and that's common for both the PM settled as well as the combo, which is the AM and the PM settled. Because it's fat, loose, ill-defined, it still could have increased volatility, and our calculations this morning are showing that we have a little bit over 1% open, high, low, close expected move. So just be aware of that. We remain heavily put dominated in the money and out of the money in terms of deltas. That's a big deal. Those are sitting overhead, and while those are sitting overhead, the deltas will continue to grow, making our book shorter, the dealer's book longer, and all things considered will put a downward force or keep a downward force on the market. Pre-market, what we call COTMP, that is the zone below us where we start seeing a transition from out of the money puts to in the money puts, 42.94, so just below us. It's come up. That happens when we get more puts coming closer to us to take advantage of a downside move. COTMC also, which is the other side of this is where calls start moving from out of the money to in the money on balance, is only a couple 20 points or so above us. We do believe, based on yesterday's action and what we're seeing in the pre-market, calls were added, puts were removed in net, and that is a slight bullishness which supports that new trigger day up. Combo complex you can read for yourself. The real key here is we're at the lower part of the transition. This is the mothership. The combo is the over 18 million contracts in the SPX. It's the AM and the PMs. We pay attention to it. It doesn't move quickly. The PMs move much more quickly, much more liquid, but we do pay attention to this, and just note it too is heavily put dominated in the money as well as out of the money on the deltas above and below us. Zero DT, folks, I know everyone is highly interested in this. We have a inverted structure today. This is abnormal. We'll talk about that here on a slide coming up. We also have this new development with a strong line at 43.15. We have another strong line where we're sitting right now at 4,300. You'll see this in the structure, and that could be a big deal. We think this is potentially a dangerous setup. If you're a bull, if you're a bear, it's a great setup. We think there is downside potential as if we can't break above that 43.15. So we consider that the line in the sand for today, and we'll have to go from there. Read this. I was going to post the if-thens. I can't post in the Discord this morning because of Cloudflare and some of the challenges that we're having. So you're on your own for the if-thens. We may be able to handle a few of them after we get done recording here. Want to move into just a recap of the JPM structure because I think it's important as a big picture of what could happen today, the so what. So here we are. This is what is expiring or coming off today. The 65s, you'll see, don't have any real relevance here. The 3550s don't have any relevance. The thing that's in play and that is really front and center for us today are the 4210s. If you're not familiar with the JPM structure, basically they have a put spread down here. So basically it's a long vertical. They're long here at this put, they're short up at this put, and then they sell a short call to pay for the debit on this long spread. When you do something like that, you end up with a delta that looks like this, and this is the delta for today that is coming off the table. So here's this 4600, or excuse me, 4665. This is the delta in that. This is from JPM's perspective. You can see it's negative over here. The blue is what we call the terminal delta. This is where we are at the end of the day. These lines are interim deltas as we go through the day. This is important, so pay attention here. We also have the 4210s, and then we have the 3550s. These are not, the 3550 is not in play, the 4665 is not in play, and you can tell that because the interim deltas just, they collapse to zero here, and you'll see what the implications on gamma are here shortly. Why this is important is that this is the right now line. This is the spot price before the open. And you can see that if we just move one standard deviation today, we're effectively collapsing deltas, which is the way it's going to be because this is out of the money, right? We're out of the money of this long put right now. If we go towards that long put, though, deltas increase disproportionately. And so behavior today is going to be asymmetric. The adjustments required by the dealers today are going to be less if we do get a price movement upward. And that's that 43.15 that I was talking about, and potentially even higher. But just be aware, we've got, when we just take the JPM in isolation, you've got an asymmetric response that is going to be triggered depending on what the market decides we're going to do today. And that's going to be largely determined by opening and closing of contracts. So be aware of this. Study this slide. I did post them this morning in the morning call channel, so you can go look at these slides and ask questions if you have anything. And we can address it either throughout the day today or on Sunday's open mic. This is where I think things get really interesting. So this is the gamma for today, what is going to be expiring. Again, this is just the JPM strike. This is not the entire complex. But it does show us that from the right now spot price, if we start moving down, gamma sensitivity is pretty significant, right? So this is JPM's perspective. They're long gamma on this side. Dealers will be short gamma. And you can see that as you run up towards that 4210 peak, which is right here, there's going to be some pretty large moves, and that's evidenced here as you start increasing price downward. The rate of change of delta gets better and better, higher and higher. So one standard deviation is sitting where all of them cross in time. That's a pretty big deal. So just be aware, gamma sensitivity to the left as prices fall is going to trigger dealer reaction. You're going to see some volatility if we move down. Dealer reaction to the right will actually start collapsing. And there are a couple nodes here that I've called out, basically that if we get up to 43.66, there is no gamma exposure from the JPM complex today. And effectively, it's nulled out of there. The overall structure, if we were to roll the die and look at where are we going for the next 3 months, It's a very well-published hedging structure. There's no magic here. It's just pure math, and these are my best guesstimates of where we're going to be. We're going to see a long put go in around 40.90, plus or minus 25 or 50 points. We're going to see a short put go in around 34.40, again plus or minus 50 points, and then they will sell, depending on what IV is today, they will sell something up here to pay for this, and this will be effectively the structure that we're going to deal with over the next 3 months. And it looks like this. So if they're long the S&P 500, they basically have a cap on their upside. It's a covered call. They have a cap on their upside. They have exposure to the downside, but only to about 5%, and then that's where the hedge kicks in, and they're relatively flat on the market. So let's shift gears here. Let's take a look over at the cumulative tick. I want to make sure everyone's aware of this because everyone's got itchy fingers to go long. You can do whatever you want, but just be aware that we are prone to failure. There you go, Tom, another call out there to the prone to failure. So if you're bullish, today is going to be a trigger day up, and that means that you would enter your longs early if you get a continuation pattern up. And that means the CT stronger and continuing up. So it closed higher than the previous day. That's good, but you can see it's been in a long-term downtrend. If you're bearish, it's now telling you to sit on your hands. It's that simple, right? This is appropriate for the 0 DTE folks. Pay attention. A little more out in time, 1 to 3 days. This is what we call the railroad track pattern. It's been moving down consistently. If you've played this trend to the downside, you've been rewarded handsomely. This is why we do it. Yesterday, we had a reversal where the moving averages start crossing. These are very short-term moving averages on the cumulative tick, and you can see that we now turn it off. And we haven't confirmed to the upside yet. So if you're bullish, the pattern is off, and if you're bearish, the pattern's off. So this is telling you to back away from the table. Unless you see a real high probability trade coming in, this is telling you you're at a pivotal point and you should be cautious. The longer term, what we call the ribbon, we only really pay attention to 2 moving averages in there. One of them is the cyan, which is a longer moving average, and one of them is the red, the shorter moving averages. They're both in a downtrend, and they're inverted. This is a bearish inversion, and this basically tells us that since red is below cyan, and we're down below it, we're in a downtrend. Nobody is surprised by that conclusion, but this helps you get on the right side of the market if you have any doubts. Do not get big on the long side if you are in the market. When you put it all together, it looks like this. This is the view we normally show. You need to be able to disaggregate it like we were just doing in the previous 3 slides so that you know what you're looking at. You've got 3 distinct time frames shown on this composite. Make sure you understand that, and the only one that applies today, because we are bearish, because the overall trend is down, is what we call TC1, and that is basically we're in a downtrend because these 2 are either non-confirming or are actually bouncing upward against the primary trend. This is the primary trend. Heed it or you will pay in drawdown, intratrade drawdown. So let's move over into the gamma discussion. So the PM settled complex, as I said, this is the transition zone. We've got plus GEX up here, minus GEX sitting right here on the left-hand side with the red dot. I think what is important for us to realize is that we closed right here at the 4330, or excuse me, 4300 level. We're right below this, right? Right below the 4300 level. Dominant level, very, very big. You can see within the net GEX column that we've got a fairly fat, wide type of transition. Typically, if you look up here where it says expected move, that's in the upper right-hand corner, 1.01%. That's open, high, low, close. And so that tells you that 68% chance of going up to 43.45 or down to approximately 42.60, 65, 55, somewhere in that zone as priced by the market. This is implied volatility. It is not how we do it, but it is a good guide to understand what the market is estimating in terms of implied volatilities. Your eye probably is drawn right to that 43.15. You've got a node here for the folks who are doing the end of day game that we have up in the channel. Look at that 43.05 zone, and then look down here. We have a delta node in the PM structure all the way down here at 42.60, which actually is in the expected move range. That's kind of interesting. Let's go ahead and go to the 0 DTE. 0 DTE is very interesting to us. So first of all, in the call OI column all the way up at 4,400, you can see that we have fairly significant call OI up there today. There's not a chance we're going anywhere near that today, by the way, but it's up there. Some people think we're going up there, but we're not. I want to draw your eye over here where we've got these two twin towers. We've got one at 43.15 and another one at 4,300. This is a fairly big deal. First of all, the two dots on the very left, the red dot is above the green dot. So minus GEX is above plus GEX. This is unusual and it's abnormal. The yellow line indicates our closing price yesterday as of 4 o'clock. What's significant about this is that right now, both of these are in the money. So we are starting the day with a fairly significant amount of deltas on the put side of the equation. Hence, that is why the net delta is showing red where we are, a little bit below us, and all above us, because it's all in the money. Net delta is above us. So your if-thens are going to be really twofold. You need to think about what's going to happen here. So if we move upward from the 4,300 zone and can put that out of the money, so 4,300 goes out of the money, meaning the yellow line is now above it, but we remain below 43.15, you've got an interesting scenario where you've got charm on one side pushing us towards a -1 in limit on delta, and you've got below us charm pushing us towards 0 from underneath, right? It's going -20, -10, -5, etc. throughout the day. So the time of day and getting trapped, we call this an entrapment scenario, the time of day between the 4,300 and the 43.15 is going to matter. If we can get above 43.15, both of these will be out of the money. They're fairly significant in size, and we believe we could actually see a push upward, not dramatic because of the overhead deltas. But if we can get above 43.15, then they become out of the money puts. Charm flow will be supportive as they decay, and then that may embolden the bulls to take off and start, adding out of the money calls, which is the upside speculation we need. It is absolutely mandatory that we start seeing that overall in the broad complex. I don't think we're going to see it today. We'll see. If we do get above 43.15 and we do see out of the money call action, watch Vol U and Vol D for throughout the day, then I think we could push towards this 43.35 zone that you see. You can see you've got net gamma that is positive there. That represents really the top of what I would call the transition. If we can get above that 43.35 and coupled with out of the money calls, we could push higher. There's not a chance we're going to go all the way up to 4,400, but I do think it is possible, all things considered, that as the bears get worried, the bulls get emboldened, that we could push higher if we can take the 43.15 and remain above it. Now, to the downside. Let's say we can't get above 43.15, or we basically get rejected off the 43.15 and stay below 43.15 and 4,300. As we go through the day, these things will be in the money, especially if we're below that 43.15. If we can't break through 43.15, then the 4,300 is going to be playing a pretty key role here. If we push through 4,300 to the downside, you can see there is a significant amount of negative gamma below us, and that's fairly significant. What's going to happen, we believe, is that we're going to get pushed downward. The bulls are going to lose faith. The bears are going to start becoming emboldened, and we could easily see a test of 42.50 or somewhere in that zone. As the yellow line moves down, even though there's not a lot of gamma shown here, you can see what happens over in the call OI column. We're really starting to lose any significant OI in the money, call OI, as we go down, and there is a lot of put OI for the single expiry. This is where put-call ratio does matter because we're on a single expiry. This is today, and if you look down where the 0 DTE POI is, it's down here at 42.10, which is the JPM strike. So all of that stuff I covered earlier on the JPM will start accelerating and triggering, we believe, the dealers to push south faster, right? It's going to be a kind of a pinning mechanism, but we've got some work to do. We've got to clear this 4,300, and basically if that happens later in the day, we do believe that it's possible to get trapped and not make any downward progress, or not make any upward progress as those things go in the money. Watch the charm flows, watch Val-D, and watch for basically where folks are targeting in the intraday as we go either higher or lower to get a sense of, are we going to move up or are we going to move down? Looking at the 1 DTE, again, we're at the bottom of transition, much improved structure. This is Monday's structure. You can see there is a start of some delta nodes coming in where we've got calls that are starting to poke through. That's good. We like that. We're starting to see a little more bullishness in general, but this is still very broken. Do not, like in an instant, unless we have a lot of calls going today, there's very little chance that this is going to be an aggressive move upward. But this is the first sign of any type of out-of-the-money call speculation to the upside, which is necessary for us to move up. You can't live on just puts closing. You have to have the calls coming in here. If we take a look at next week remains very bearish. With the structure we have this morning, we have a lot of overhead deltas that are in the money, put dominated, and out of the money, put dominated, with the exception of just a few strikes here. Keep an eye on this. Next week still looks to have pressure on it, but I will note that the net gamma for next week has reduced. And there's a couple of things that go on in that, but the statement in general, when you take a look at net deltas and net gammas, especially on the spreadsheets, you're going to see that we did reduce from prior days, which is slightly more bullish, but still the bears are in control. Finally, taking a look at the AM and the PM complex, this is the mothership. You can see over 18 million contracts here. This is everything all combined. Decisively bearish. Right? The overhead is very red. That means the deltas, the put deltas, are in control. These are in the money. They're going to remain in the money. There is a transition zone that has to be cleared here, even though you can see this big white box here. We've still got a long ways to go until we get up to 4370. We are not going to start seeing character change in the complex, in the full combo complex, until we get up into that 4370 zone. So we got work to do. To the downside, very ugly. Out of the money puts are ruling it on the deltas and on gamma. Again, that 4200 in the PM complex, or excuse me, in the combo complex, is the downward strike. And frankly, it's the downward target. So we are below the 4,300. You can see that's a major line. The next one will just continue to grow as we move down. That's a big deal. So beyond today, just be aware of what we're facing, and we'll see where things go. Finally, I just want to highlight, I like the landscape view. I like looking at the landscape view in the context of what's the transition look like. And it actually looks pretty poorly. So here's spot price. We've got a couple spikes up, a lot of still. We're deep inside the muck. I've highlighted this yellow box. We've got to do some repair. We need effectively plus trans and plus gex to move down. We're not seeing any of that. We're not seeing the call speculation. We're seeing a lot of put speculation. That's what this is showing you. Until this gets more balanced, we're not moving up. It's that simple. It just works that way.